Welcome, new episode, new year with the market reporters. What did we do for you in this week? It's Thursday afternoon. We compared the outlook of 9 different asset classes from 15 really important institutes. Happy New Year, Taco. Happy New Year.
Happy New Year
to all of you. Every week, as you know, we talk about the stock markets, and we try to do it in a different way. We try to give you some pragmatical examples and ideas that we discuss during the week with our investors. This week, we're going to do it differently because it's the first real week of the year. And if you know us for more than 1 year, then you know we always say something about the outlook of the market. And I want to highlight something because we are not sharing our view, because who are we? Who are you, Taco?
Taco, but not really relevant in this context.
If you are a client with UBS, around this time of the year, normally in December or sometimes November, you get a really nice report, really nice PDF in which they share their outlook on the economy, on the world, on shares, etc., etc. Then you read it and you go, that makes sense because the arguments are really well defined. Then maybe you're also in the lucky position that you have a bank account with Santander. You read that report and you think, wow, that's also really good. And then you compare them, hey, and they're different. So what I want to say is that if you are with one of the biggest institutes, you still have one vision of that institute. What did we do for you in this week? It's Thursday afternoon. We compared the outlook of 9 different asset classes from 15 really important institutes. And with institutes, I mean, like what I just said, the banks, but also Dutch banks like ING, but also JPMorgan and Morgan Stanley. So if those banks have a vision and it's all almost the same, it says something about the market. Guarantee until the door, because that's what they think today and tomorrow, especially now in the world we are living in, things can change on a second basis. Well, we did this exercise for you. It took us a couple of days because not everything is open source. We had to read the reports. We did it with Paolo. He helped us very well. Thank you, Paolo. And what we're going to share with you, the averages. And at the end, we did an exercise. We did it on the site in which we can show you how the analysts, how good or not good they are on average over the last 20 years. So you have to stay focused. And
quite surprisingly, I think the results from the analysts.
Definitely. Okay, let's start. The most important one compared to shares, S&P 500, it's now trading at 6,900 something. And all the analysts are positive. They're quite close to each other. Some say a small jump, but on average, they think the market S&P will go to 7,500 something points. So that's a jump of, let's say, rounded off 8%. 8% expected growth for the S&P 500 for 2026. Taco.
STOXX Europe 600, the other important stock market, now around 603, and the average of the analyst is 652. So a quick calculation makes that actually it's also 50 higher on 600. So also 8% is foreseen the growth by the analysts. So I think we could say like the biggest markets, US and Europe, for most of our traders, they expect to be very positive, 8%. China, a little bit further away, literally, but maybe also for you as an investor. This China index is now around 63 and expected as an average is 69. So actually that's even a little bit more, 10% growth expected. Also here, also with Europe, everyone is positive. So I can make a small conclusion maybe that the equity markets for those 3 regions are expected to grow for around 10%. Very positive indeed.
And they all gave an estimation.
Yeah.
So they really also they're also keen on China.
Yeah, that's good to mention. Yeah.
Commodities. We have 4 commodities. So after the shares, the most important share markets, we think the commodities, the important one nowadays, a really hot commodity. We spoke a lot about it in our vlogs over the last years. Gold trading at 4,400 something per troy ounce. I think it was the biggest growth last year of gold since 1970 something. I don't know exactly. So it's already, I'm really a bit scared that analysts will say, okay, they have a line like this and the line will continue, because that's what they think. And if you look at the estimations, almost all of them are positive. I have to read it. Only two I think it will stay the same. On average, 4,400 something now. The market think it will go to 4,700 something. A growth of almost 10%, let's say 9%. Positive if you're long in gold, and when they are right. Silver is always difficult to predict. We made a vlog on the 16th of May, and we did a recap in December, in which we said, okay, based on fundamental analysis, silver will grow because supply and demand. Yes, it did. It went from 36 at that moment, $36 per troy ounce to 77 what it's trading now. And it's so volatile now. Today it went down 4%. And it's common that analysts don't give forecasts on silver. If you compare how many analysts give a forecast for silver compared to gold, then there are only a few, like on 30%, not even. On average, they think it will go down. And I have to say, because it's so volatile, silver, I don't know when those estimations were made. But on average, they say $63 per troy ounce. But I don't pay too much attention to the silver.
Brent crude oil, 61 trading now, actually 2% up today. So like you said, it was actually around 59.60. And yeah, the analysts are not very clear. Most are thinking a small decline, average of 58.90. So like I said, actually that was close to the price of yesterday. So not a lot of expectations here. Maybe because it's very difficult again to make expectations, especially what's happening now in the world. But most of the analysts do have a vision on it. So it's like around 9 out of 15, but not a very clear signal. For gas, Henry Hub now around 3.44. There is a clear signal with an average price expected of 4.42. So that's $1 higher.
That's percentage-wise, 30%.
Yeah, but also here there are only 6 analysts. So I think it's difficult. I think we had a very nice vlog around it about this subject, and the analysts are all US analyst banks. So in Europe, they are not very keen on giving their expectations.
Real estate. And real estate is slightly different because real estate is such a big, of course, asset class. So we are only concentrating on the listed companies, worldwide real estate, global real estate listed companies. And the estimations are slightly different because you can't compare figures to figures. So this is in a percentage. All the analysts gave their opinion, all of them. That's the only asset class where they did it. They're all positive. They're all really positive. They're all positive with 2 figures. And on average, they say this market will grow. I was surprised, by the way, what's happening in the world and with the prices. It will grow with 17%, and that's the growth, everything. So that's the value of the real estate and the rent income. So real estate, global real estate, the market thinks it will grow with almost 17%.
Euro dollar, it's 2 currencies, obviously. Now we're trading around 1.167, and all analysts are expecting that the dollar will become weaker, around 120 on average. Again, a very difficult one. I think if people ask me, something about it. It's the biggest market, bigger than the stock markets, I think 10 times bigger. So who are we, and maybe also who are the analysts to say? But on the other hand, I think, after the price movement of this year, 2025, I think it's generally expected that the dollar will become a little bit weaker, but you never know. If you have dollar positions in your portfolio, like last year, it is important because 120 means that your value in dollars has less value in euros. So it is, if you share that opinion, then you should maybe act on it. But like we said, it's just an expectation, but everyone is thinking that the dollar becomes a little bit weaker and the euro stronger.
So that were the 9 asset classes. I hope you liked it. And as promised, we also looked at how good or how bad the analysts are on average. We only looked at the S&P 500 because it's the most important stock market. We went back 20 years, so we went back to 2005, and we showed the chart. And what you see, the chart is in Dutch, by the way. What you see a blue line and a yellow line. And the yellow line is the forecast of the analysts, and the blue line are the actual end of year quotes of the S&P 500. What do you see in this chart? You see that the direction of the analysts is always good. Always good. If you look at 2008 and 2022, then the analysts thought, okay, the S&P will go down, and it went down. The other years, almost all the years, it went up. They expected that it went up, and it went up. So that's really, I think, remarkable and really interesting.
As I said before, it surprised me too that they are not just saying something; they're right, and not that far. I mean, it's like 5% on average.
So explain the bars.
Yeah, the bars is like the difference between the result actually. So how. What was the difference between their expectations and the results? So that's on average like 5, 6, 7%, which is still a lot. But on the other hand, if you know that the direction is
but
correct,
less, maybe it's like 4.
Well, that's 4.
There's
one big one, maybe in
2008.
That was very difficult. But on average, like 4 in the normal years, I think it's not a bad result. And what you asked me before, they are always a little bit too positive. That's something else we can make as a conclusion, because the yellow line is a little bit higher always than the facts.
Yeah, so if you look at the forecast for this year, 8% growth with an error margin of 4%, the S&P 500 will grow this year with 4%.
Well, very clear. That's it. We know enough.
I hope you like this outlook. I think it's quite we find it really interesting, the outlook.
And useful.
Yeah, useful. So if you want to have more detailed information, you can reach out to us and we can share it with you. For now, again, Happy New Year, and use this information for a fantastic, healthy, and also healthy life on the stock market.
Financial life.
Financial life. Give us your thumb.